Contentious issues in private business valuation. Number 2, defining value. In the last session, I talked about price and value. And now I'm going to talk about the different definitions of value, what we call the basis of value. We're quite fortunate now to have international valuation standards that guide us on valuation. And in the international valuation standards, which are provided by the International Valuation Standards Council, they define various bases of value. And the basis that we see most often is market value. Market value is defined as the amount exchanged between a willing seller and a willing buyer at arm's length, not anxious, both parties fully knowledgeable, full marketing. And that's what we call market value. But it might be that market value isn't always appropriate. We have other definitions of value. There's synergy value, investment value, equitable value. So synergy value would be the value that's unique to a particular investor. So a public company is coming to acquire a private company. There could be some significant synergies, cost savings. They've already got a lot of the overheads, some staff savings that's going to reduce their expenses, increase their cash flow. And so the value to that specific investor is higher. In some situations, that basis of value might be more appropriate. We have investment value, and it may be that the value to an investor is higher because they have a lower cost of capital or they've got more debts. They can reduce their cost of capital. And then we have equitable value. And rather than saying market value, we're saying what is equitable to the parties. This is sometimes called in the courts fair value. What is actually fair? And it might be that market value isn't a fair value. And we see this in minority oppression cases. And so a minority interest is being oppressed by the majority shareholder. And if we were to value it on a market value, that market minority interest might not be worth an awful lot. It's not very attractive, an oppressed minority interest. So maybe we need to value it on an equitable or fair value basis. Look at the value of the whole business, selling the whole business on a controlling basis, and then work out the value of that small percentage of shares on a pro rata basis. So to sum up, it's important that we get our basis of value right to start with in a report, because if we get the wrong basis of value, everything else falls apart.